Swayam Prabha. Digital India. Educated India.
Hello, my name is Atul Tripathi and I'm Honorary Adjunct Fellow at National Maritime Foundation. This is a part 8 of the lecture series on ESG analytics and green finance. Today we will be talking about the sustainable wealth investments and how you do it, social responsibility investments, and how do you do that, We'll talk about the blue finance, the use of blockchains in this regard, the artificial intelligence, and we'll take through some of the case studies as well. So let's go ahead and look at what the excitement is all about. First thing first, ESG financial risk, when you look at it, also has a resilience engine, but you need to compare it. You need to take into account, because you see that today's market is no longer about a nice to have, as I have said all the time. So companies with top ESG score are enjoying an average about 20 to 30% lower the capital compared to the low scoring one among the peers. This is as per MSCI ESG Research 2023. So there's a complete link between ESG and financial performances, whether in terms of revenue opportunities, environment, investments. One of the things that comes across the mind is, what is this ESG financial intelligence, risk intelligence that we're looking at? It's about the reputation metric, where it is about driving the capital costs directly and into resilience, because the financial institutions, they are embedding the ESG into credit risk, the pricing, the portfolio construction, the insurance, and the other factors that we have been talking about and discussing at various time periods. So it's about integration and strategically into becoming a financial necessity rather than just as an idea, because ESG is it's a financial material now. The world has started to look at, the companies in particular, they have started to look at that angle, because the link is very clear. Essentially, poor ESG governance means your environmental neglect, and which will result in your increase in the operational risks, your higher regulatory scrutiny, reputational damage being one of the big areas that the companies are looking at. Then the cost of borrowing the capital increases, because the lenders and the investors, they are increasingly becoming very conscious regarding the ESG ratings while pricing the model. So the higher the ESG rating, the higher the ESG risk, I would say, the higher is going to be the premium demanded by the investors, And therefore, your market access with respect to many of the green bonds and the sustainability-linked loan (SLLs) as we discussed in the past, and the ESG investment funds, they have the minimum ESG score thresholds. So the poor performance are the ones that are going to be excluded very immediately as these capitals become poorly available based on the certain factors that have been taken into consideration. And obviously, we talked about the policy and the regulatory aspects of various lifetime periods, whether in terms of disclosures, whether it coming from EU, SCSRD or SEC, climate-related risks and all that, and the financial markets, how they have greater visibility into ESG risk, and how they are translating their faster capital into repricing. So it's a completely linked cycle we're looking at, point out here. So we're looking at from the productivity to investments to cost of borrowing to regulations to what should be a strategy, how should the environmental be paying into the societal aspect, and finally this is all coming into the play of cost of borrowing, as I said. So the ESG analysis, it is becoming a completely holistic risk view, where your companies like S&P Global, they're emphasizing that ESG evaluation is going to be expanding beyond environmental and social dimensions, so as to provide a comprehensive and a perspective on the corporate governance, and particularly in terms of emerging risks. Then the legal and the reputational risks, they're material in nature, because ESG failures will lead to litigation, reputation damage, which may materially be affecting your credit worthiness. The cost of borrowing, as I've been insisting, is going to go up. So 1,300 climate-related lawsuits are already in play, and the spotlight is again on the financial stakes that is there, because this ESG-related missteps that the companies may have taken knowingly or unknowingly. One really doesn't know in that area. So ESG investments, they're benefiting without compromising. It's about benefiting without compromising on your performance altogether, because When you're trying to align a portfolio to higher risk scores, you are significantly boosting your ESG quality by at least 20% to 25%. These are the various reports that I've come across, while preserving the fundamental characteristics like volatility and returns. This is as per the various news releases, particularly coming from respect to the S&P Poor's. And that from values to value, the evolution of how ESG integration has been taking place. Because you see, understanding social responsible investment, or SRI as we call them, that is where we're looking at from the ethical lens to environment sustainability to negative screening, impact investments, measuring impact, what about the financial performance due. Essentially, there are 4 different values or levers of value that ESG value creation model look at. One is the risk, where non-compliance will pose a significant organizational risk, particularly social component, which is going to be resulting in lowering the value and hiring your capital access to capital bonds. What about your reputation? So that becomes another important point, because organization ESG reputation is at stake. And therefore, the move from SRI to ESG marks, this is a complete change that is happening. From SRI, we're moving towards the ESG for the transformation of sustainability from a moral choice more to a market-driven economy, or market choices that the companies and the investors and the small investors or the large institutional investors are looking at. So in SRI, the focus was on aligning this investments with moral or ethical principles, while in tactics was around screening out the undesirable sectors like weapons or gaming industry or gambling industry, more to say, the fossil fuel industries. So the outcome was often accepted based on some financial trade-off or ethical alignment that one looked at. While in the value-based ESG approach, which is now becoming the integral part, you are looking more in terms of incorporating ESG into the mainstream financial systems or the analysis or the financial background that you're looking at. The tactics is completely feeding into the return, the risk model, the stress model, the return models that of the world. The outcome is again becoming very target outperformance through the downside of the risk, or in terms of capital cost of borrowing, has in mind, and the reason is, empirically the evidence and the others show that ESG is financially a material, and ESG scores will raise your financial costs, which we have discussed a lot in detail of. Strong scores are going to correlate with better risk management. They're very data driven, which we'll again see in today's this one. AI, the use of GIS, the blockchains of the world. How do you do ESG risk monitoring, ESG risk prevention, and the factors that you need to. So one of the big aspects that comes around when we look at it is in the terms of carbon matrices. Is now covering over about 23% of the global emissions, and it could triple by 22 banks. So the net zero economy in the carbon isn't just about emissions or assets that you're looking at. So if you see from 2005 to 2025, all emissions covered the direct carbon pricing compared to 5% in 2000. About $100 billion plus of revenues have been raised in the consecutive years. That the carbon matrices they have now become a financial metrics all the way. They're basically integrated in terms of valuations, lending. Then the intensity of the carbon is about measuring per kilowatt hour or even per ton of the product. That's how the metrics has been calculated. The key is around comparing with the peers across the sectors, not only within the sector, it is not only intra-sector, but also inter-sector as well. So the lower the intensity, the lower is the transition risk one is looking at, because the absolute emissions is coming in 3 different scopes. Is the first scope is around direct emissions from owned or controlled sources. The second scope is around indirect emissions from purchased electricity or the heat, and third is all the direct, indirect emissions around the value chain. So the scope 3, that is the third scope, where you're looking at the indirect emissions from across the value chain. That is where it is accounting for about 70 to 90% of the total emissions, because that is where the criticality of the full-scale assessment is required. The carbon pricing and the policy exposure, the more adjustment jurisdictions and implementations on the carbon taxes and the cap trade systems and the carbon cost, they are directly impacting the profit margins, because we have talked about the stress testing of the portfolios, which was carried out against 150 trillion carbon dioxide emission scenarios, revealed various stranded assets that are at risk. So why does this actually matter? Why does this carbon metrics become the new currency of the risk and the opportunity? It's essentially around three factors. First, the investors, they are using the carbon metrics for credit risk modeling, your ESG linked loan approvals or loan lending. Second is the insurers, they are assessing the carbon matrices to look at the transitioning risk from the pricing, from the property and the casualty risks that we're looking at, the portfolios that they're building. And the third and most importantly, the companies will start, they with strong carbon reduction strategies, they're attracting lower costs of the capital. So three main areas or the focus that has come down because of this carbon metrics. One of the factors that we also come across when we combine the carbon metrics and we look at the multi-hazard, something we discussed last time around, it's about turning the climate data into capital decisions. Because about $4.3 trillion or listed company market cap is at risk from the climate change by 2100, and 50% of that risk is insurable or hedgeable via indexed instruments, as per World Bank. Because there are various dimensions of the ESG risk, whether in terms of cyclone, drought, and it's impacting the various sources, like take the case of drought. If you look at it in terms of crop insurance and triggers and the food commodity. And in order to measure that, as we discussed in the last series about the Palmer Drought Severity Index, PDSI, the data sources are essentially coming from NASA and the US Drought Monitor, which we discussed as well in the last time around. Then if you look at the carbon metrics particularly, you have the carbon intensity or the scope, that's something we just discussed a few seconds ago. Then the sources that we're looking at is CDP and GHG protocols. Because the financial linkages, as we talked about, it's coming from the ESG linked loans and the transitioning of the pricing mechanisms of the pricing, because an unified ESG dashboard is going to transform your climate metrics from data points more into the financial levers for risk adjustments that needs to be taken care of. And why do we need a multi-hazard approach rather than just a single approach of just measuring the carbon metrics? Because the risks, they're not happening in isolation, So the carbon policy shocks, they will coincide with the extreme weather events or amplifying your losses, Then you're combining your hazards into composite ESG risk index and you're improving your portfolio stress testing. What about your catastrophe risk modeling we are looking at? That brings us to the other second factor is about carbon metrics, which is given the context, the carbon intensity and the scope 3, as we talked about the indirect impact on the complete value chain. How do you treat it alongside the weather risk for transitioning to physical risk transitioning? What about allowing the insurers to adjust their premiums for both the climate change damages that are caused because of the climate change and the insurance policy driven market shift that is happening? The use of AI and GIS, as I've been stressing, is becoming very, very important, and it is being fused across the board, particularly where the GIS is showing the assets that are under stress and what assets have been exposed due to carbon metrics. The AI models which are forecasting the risks that may be materializing out. The enabling of the automated triggers with the parametric insurance payouts and the dynamic ESG linked bonds. So this is resulting in a direct financial implications because the banks, the bankers are able to adjust the lending rates based on the combined hazard with carbon exposure scores, while the insurers, they are pricing their policies dynamically based on some real-time indices, and the asset managers, they are reallocating the funds altogether to a lower risk and a higher resilience portfolios. These are three main areas or the focus areas why this is becoming such an important and integral part in today's decision making as far as carbon pricing is concerned. That brings me to another important point, and that is about thematic investment, where we're looking at funds which have grown from $148 billion in 2019 to about $800 billion in 2024 that has actually outpaced the broader fund market, that is as per the Morningstar Thematic Funds report. But what exactly is thematic funding? If you look at it, it's about long-term structural trends and social, environmental, or even technological changes rather than just the short-term market gains and capital market changes that are happening. Because the thematic investment is about bridging the mega trend awareness with the targeted capital allocation all the way to turning the global risks into more focused opportunities because of the various factors, that the complete growth in this area and the trend, because the global trends, whether in terms of climate change or urbanization or even the use of artificial intelligence, they have created both the systemic risks as well as your investment opportunities. It's a combined factor of both of them that is resulting in your strong alignment with ESG mandates and investor values. That is connecting your ESG with the multi-hazard matrices like where you can identify the thematic investment opportunities in terms of resilience of the infrastructure or the pollution control, even in terms of carbon reduction of the matrices, which we've been talking about. Some of the examples, if you look at it, is, if you have high AQI urbanized zones, then the investments are turning into urban green and clean transportation. Or take another case where you have a high coastal flood risk zone, which is turning into your investment in resilient housings or seawalls or early warning systems. Because the asset managers are looking more at the thematic ETFs or exchange traded funds as to track climate resilience and decarbonization across the board by the leadership. And the insurers, they are looking at the co-financing of the resilience of your projects in high risk areas or so as to reduce the claims altogether. Now that's an important factor that one needs to consider, because if you observe very closely, the next thing that we're looking at is in terms of then the similar lines in terms of your green bonds and the blue finances of the world, because the green and the blue finances, they are not only lowering your climate and the pollution risks, but they're also converting your ESG metrics into more investable, profitable portfolio, balanced portfolios, because the green bonds, they're like your debt instruments which have been funded environmentally beneficial projects such as renewable energies or energy efficiency or even pollution control areas. And the blue finance is about, where you're directing your capital towards your marine and freshwater ecosystems, the coastal resilience and the sustainable blue ocean economies. Why has this become such an important factor? Obviously the green bonds, they are financed through your drought resilient agriculture or your cyclone resilient infrastructure or urban cooling projects, where you are addressing your air quality index with your UHI, urban heat index, both of the factors that we discussed in the last lecture series. Then the blue finance, it's going to support your coral reef restoration, which is coming from because of the natural storm barrier, which is actually a natural storm barriers, and your mangrove protection, which is for the flood mitigation and sustainable port infrastructure, because the global green bond market has surpassed about $500 billion in annual issuance in 2023, while the blue finance remains untapped $1 trillion opportunities as per climate bond initiative reports that have come out. So, if you look at some of the real life examples, it's coming from Seychelles Blue Bond, which has been funded marine protected areas and for sustainable fisheries. The World Bank Green Bond, which we talked about lecture series ago, is about financing your renewable energy and the carbon transportation in high risk zones. And this is all linked to your risk indexes in both the structures, because the typical bond coupons for the multi-hazard risk indices, such as you say drought severity and your cyclone ACE and the carbon density, something we discussed earlier. Investors, they are being rewarding for the funding of the projects that are measurable, where you're reducing your pollution and the climate risk. Let's look at some of the areas, some of the platforms that talk about this climate bonds and the insights that are there, what you can derive out of it. So if you observe out here, we have this website, where you can go around, you can look at the compliance methods, and you can also check whether what kind of instruments are there. You have ETFs, the carbon taxes, and the government crediting your mechanisms, and how much is the pricing that is going on right now, revenues and the carbon credit markets you're looking at. So as we hover around each of the areas of the, say, Saudi Arabia, the green gas crediting and offsetting mechanism, which is called a GCOM, which has been implemented in 2024. Take the case of Australia, which is about, safeguarding your mechanisms and Australian credit card mechanism scheme that is there. You can also look at the carbon credit markets, what are the conditions at this time period. So you can play around with this platform. You see, you can also download your data. One can see at this time period what is happening. Take the case of India. So we have verified carbon standards, we have the gold standard with the plan Vivo and the clean development mechanisms. Look at the amount of cumulative issues that have happened since 2016. What about the credits that have been issued in case of India? What about Brazil, one of the rising economies in the world? Similarly, for Russian Federation, you can clearly see that what is happening. And that also brings me to another point, is about the instruments. What are kind of instruments we're looking at? So this platform allows you to play around with, again, in terms of the regional and the national and the subnational, how many of them are there, because that gives you if you look at it from the perspective again of India credit mechanism, which has been under development since 2022, and that the China GHG voluntary emissions reduction program, which has been implemented in 2012, to Canada, which is talking about Canada Federal GHG offsetting systems. So you have these platforms where one can play around with these kind of systems, and one can look at your climate bond data. You can download your data all the way down and see what is happening. That also brings me to another point, and that is about the blue finance, which we talked just a few seconds ago. So blue finance is all about the thematic investments, as we talked about. How do you bridge the mega trends rather, from the awareness with the targeted capital allocation, because you're turning your global risks into a complete focused opportunity, and it's a completely $1 trillion untapped area, because thematic investments are focusing on the long structural trends and figuring out how this happens, because blue finance is about financing the sustainable use of conservation of ocean resources while you're delivering your measurable climate and biodiversity benefits, because the blue finance is turning the global protection from a charity into an asset class altogether, because it's going to cut across the climate risk and it's going to drive your long-term economic resilience. The current the ocean economy is about $2.5 trillion annually, but the resilience depends upon where the capital flows. This is coming from blue economy. If you look at what exactly is it's blue economy, so we tend to think it's about fishes and shipping industry. No, that's just one of the factors. What about the air we breathe? What about the blue carbons we're looking at? Because the mangroves, the seagrass, and the salt marshes, they're removing carbon dioxide from the atmosphere 10 times more than the tropical rainforest, and storing about 3 to 5 times more of the carbon. Thus decreasing the impact on the climate change. So it's about $1 billion opportunity that is estimated in terms of the mangroves in EAS regions. What about your ocean energy? The ocean is going to produce about thermal energy from the sun's heat and the mechanical energy. Because you can have offshore wind power, the trade and transportation. What about the fooding? Oil and gas to incomes, to medicines, to tourism. So this is where, it's a much larger thing that we're looking at compared to what we tend to think it's all about ocean economy, is all about fishes and ships. No, you can have coastal resilience and the sustainable fisheries, because the integration with the multi-hazard risk matrix is becoming very important. Because take the case, where you have the coastal storm surge and the cyclone ACE indices, where you're targeting your restoration in high-risk areas, or your drought and river flooding factors, where you're protecting your estuaries and the wetlands of the way, which has been under water regulations, your air quality index, and your marine pollution, which is being funded by where you can fund your harbor emissions and your reduction in the projects. That brings me to another point about the financial instruments. So one or two of them, blue bonds and your insurance-linked blue investments. So blue bonds actually talks about the debt instruments where your proceeds are dedicated to sustainable ocean and coastal projects, while they are insurance-linked blue investments. They're about your premium discounts for the ports and the coastal cities, which are adopting your resilience measures. So the impact in the financial and the insurance market is very high, because it's lowering your insurance loss ratios in high risk coastal markets. Obviously very beneficial for the large scale commercial projects or even infrastructure projects, to even the small scale borrowers, which is meeting about your SDG goals, where SDG 14, life below water. to enhancing your sovereign creditworthiness because you're able to protect your GDP from the climate shock. That also, another platform we look at it is in terms of this oceanpanel.org. If we go out here, we can clearly see that this, it gives you a complete area. This is about the various 18 different countries that have been working together to capitalize and catalyze your implementation of these solutions around the world. And you can go to one of the countries and you can play around with it and you can see what is happening on this platform. It gives you a pretty good area understanding of what is happening. So let's take the case of Australia itself. And when we increase it, it gives us a complete picture around the world maps, how it is happening, what is happening. So if you can clearly see what's happening, this is a very good website to visit and see what is happening on the blue economies. And another thing on the climate bonds, we were talking about, you can also see the amount of if you go down to this climatebonds.net and you can see the amount issued or the number of deals that have been happening. You can play around with it while you hover around it. You can see the number of deals that have happened in the climate and bonds is around 303, while in the US it's around your 1179. So you can also have a look at it in terms of global economy. Say, if I want to look at Asia Pacific only, and I want to look at all the three things, developed and emerging and the supranational. So I can clearly see what's happening in how many deals have been done and what has been happening. So one can visit these websites and check out the important factors around this. So another one of the websites that one should visit to look at the blue economy, is this one, Resource Watch, and you can see out here, you're looking at marine and transport and the mineral energies and the fishing of the world. You can just look at the data over from 2002 till about 2018, what is happening, how is the shipping industry across the various major shipping companies in the countries in the world, from Portugal to Poland, Latvia. So primarily they cover about the European countries, and you look at the minerals and the energy, so you can transload about it and the kind of information that is available, both in the marine energy as well as offshore wind energy, and how it has been going over a time period. Similarly, for the fishing industry, if you look at what's the global fishing industries, with the fishing effort with the captured production that is happening. And once you go to the various, the coastlines, so take the case of India itself, what is happening, what is the biodiversity to your blue economy, to your eutrophication risk that is there. So let's take the case of blue economy, since we're talking about it, how is it impacting? So it's about less than 1% of the carbon dioxide emissions from India currently is generated by the shipping industry. You can clearly see the trend lines that have been happening since a long time period, about 2000 till about 2018. One can play around with this and look at the data factors. What about the minerals? It's about renewable energy from India. So they haven't updated this thing. How many hours have been spent by the shipping in about 200 nautical miles from India. What about the marine protected areas? So one should definitely visit these kind of websites to figure out what is happening in the various aspects of the blue economy. As we say, that when we look at a blue finance, we also look at, we should look at it in a multidimensional aspect, and one of them is the multi-hazard risk that is there. So the multi-hazard risk is about, the blue finance projects which are addressing your multiple ESG risk categories, such as in the physical or transition or the biodiversity risk. So when you look at the blue economy in the multi-hazard areas, you look at this dashboard, where you're looking at AQI to about the various aspects of mangroves to maritime reserves to blue finance, and how is it impacting over time with the percentage changes, what is the so every $1 invested in the mangroves is actually yielding about $3 avoidance in damages. This is as per the WRI. So it's a very important fact. What about the hazards when you map them with the blue finance? If you look at it from the cyclone and the storm surges, or the risk to this is helping you in the intervention would be from the mangrove and the reef restoration, because this is going to reduce mechanism will be in terms of natural barriers or reduction of the heat wave height. Or what about the storm surges impact? Because the financial implications will be in terms of lowering your insured losses and reduction of the catastrophe premium. Something we just talked about. What about the urban heat and AQI stress? The relevant blue finance intervention would be in terms of poor electrification to coastal green belts, support in electrification to coastal green belts to reduce so as to reduce your shipping and emissions and urban heat islands, and which will actually result in your better air quality indexes, resulting in your AQI eligibility for your AQI linked bonds. So this is another important mapping of the various hazards to your relevant blue finance, to your risk reduction mechanism, to financial aspects. It goes through these things. It's a very interesting area. Now, a few of the websites, which give you a pretty good, thorough information regarding all this is, we'll take to one of them. And when we look at this thing, we just saw this point, Let's take another case. Let's take the case of Indonesia, and let's how it plays around. So again, 3% of ocean within 200 nautical miles of the coastline of Indonesia is protected, including the overseas territories. How they have been progressing with respect to your 30% of the ocean that is there in Indonesia. How is the island being polluted, and you can also play around with this how is the soil erosion going to be happening. You can clearly see markers out here. As you move around, you can clearly see the way it is happening over a given time frame from one legend to another legend. So let's take the case of Crete from this time period, So to the extent to they have mapped it out with your marine protected areas. So one moves around this platform, you can clearly see what's happening around it. Similarly, for the case of when we move down, we can see the kind of high erosion prevalence or the forest cover losses that have happened over a given time period. This again, how is the island cover related to water quality in Indonesia. So one can move around and see the kind of impact that is having. This is the kind of a platform one is looking at. Another thing is on the very famous and very popular one that we've been talking about is Think Hazard, where you are looking at, again, I'll take the case of India as particular in this case about Think Hazard, and I've done the study around Andaman and Nicobar Islands, the impact of the blue finance and the multi-hazard and the risk factors, So when we look at it, it's got Andaman and Nicobar Islands have being situated in the Bay of Bengal are very, very prone to volcanic eruptions, to tsunamis, to erosion of the coastal lines. So it's a very typical use case of how the impact of the various aspects of natural disasters or the multi-hazard is happening out there. So again, one can look at the various, talking about this, you can see the changes that has been happening. Urban flooding where it is high, or coastal flooding is also high, while your earthquakes and tsunamis have been ranked as low, while the volcano has been ranked low. River flooding, obviously, water scarcity and wildfire is very, very low, because this is a very prone area, and they're more prone to your areas of, it's going to be high in terms of the coastal flooding to urban flooding. So this is where, this is a very, very popular platform to go to and look at it, what is happening out there in this blue finance with the multi-hazard, factors that you need to take care into consideration while designing an ecosystem or platform of this nature. Now, let's take this use case, where just a scenario that you have taken into consideration. So I'm assuming explicitly that about my coastal asset portfolio is around, $500,000 to about the relevant hazard we're looking at is in terms of coastal cyclone and storm and surge with an annual probability about 2%, and the baseline vulnerability damage we're looking at about 40%. The mangrove restoration protection about 40% of the exposure, and is reducing your vulnerability to that of 30%. So when you look at a catastrophe bond that is being issued, the notional value of $100,000, your pricing rule will be around, how do you look at it from the risk-free base coupon about 1% to risk premium, where you are loading and your expected annual losses and notional losses, where the loading factor is 1.5. The cost of mangrove projects, for this example, we have taken is so many dollars we've taken under the ROI. The first step is to calculate your expected baseline expected loss, or ELI, for the cyclone event, where the formulation is around ELI is the probability into exposure into vulnerability. Now, we've calculated based on all these values that we have taken, assumption values that we have taken into consideration. So my baseline ELI comes around this much. When I look at it, and the second step, after that, I've taken the baseline ELI after the mangrove restoration that is there. So we have divided up into two parts, the unprotected part and the protected part. So out of the 100%, I'm assuming that there is 60% exposure to 40% exposure. Multiplying that out, because there is this values that we're looking at, that the coastal portfolio values that I'm looking at. So again, I do my vulnerability calculations out here, and then I sum up it with my, all of them. I'm going to sum it up, because I'm going to calculate now the effect of catastrophe bond coupon, the pricing that I'm looking at. So coupon bond is going to come from baseline plus loading multiplied by ELI divided by notional. And when I do that, because you see my ELI was there about this many, and I've taken the ELI by divided by notional value, the risk premium and the full coupon value. So finally, my blue bond credit, or the spread that I'm looking over, I've taken the two scenarios. You can take multiple such scenarios. The expected loss drop is going to be about 12% of the proportional tightening of the credit spread I'm looking at. For example, if I'm assuming that the original spread is about 200 basis points, so your new spread would be about 24 basis points based on this calculation. And finally, your projected ROI, which is going to be a simple payback, or your benefit calculation. If you're looking at the cost of reductions around so many dollars, simple payback is cost divided by annual benefit, so which is coming to about 8.33 years. So this is one of the ways to calculate the blue finance catastrophe model bond spreads over considering the multi-hazard risk into factor, because this is a big area, and it's a highly sensitive, price sensitive driven area when you're looking at. That brings me to another important point, and that is our the various indices on the ESG factors. So one of the factors that we've taken into consideration is that S&P Standard & Poor's ESG index, which is about benchmarking your sustainability and how do you evaluate or rather elevate your performance, because over the 5 years S&P 500 ESG index has cumulatively outperformed the standard S&P 500 by about 15.1% approximately, while maintaining a similar risk return portfolio. Because if you see out here the growth that has been there, and the sectors that they have divided up their ESG index, you can clearly see the growth in terms of S&P 500 versus S&P 500 ESG index. Almost at every given across the sector, there has been an increase across the sector, apart from utilities and your industries. Apart from these two, you will see that there has been, and even to real estate to some extent, and most of them have been a growth. You see a growth across the sectors, because S&P ESG index, it's about a variant of the S&P 500, where you're filtering out your weak ESG performers, and you're maintaining your industry balance, because you're trying to target 75% of the industry-led market capitalization, and you're excluding your companies in areas like tobacco or non-compliance areas on the UN SDG goal sectors, So S&P 500 ESG index actually proves that sustainable investments can actually perform alignment and not just the values driven. It's a live case of how ESG integration is actually about smart risk management, about portfolio optimization, and it's not a trade-off that one is trying to do, because the performance and the risk profiling, when you look at it, despite the screening and the ESG version, where you are maintaining a tracker, of errors which is about 111 basis points over 10 years, which is a very, very tight numbers you're looking at, to over about 134 basis points for a spread over 5 years. Nearly 99.9% is a correlation to the parent index, and it's ensuring that the minimum trade-off is happening between the sustainability and the performances, and and the outperformance that actually happened by 15.1%. Because the materiality and the ESG quality is important, and that's where the index is showing the improvement in the ESG matrices, because the carbon intensity, the trillion carbon dioxide emitted per $1 million, you have the US ESG index sponsors 109 versus 134 for standard index to carbon footprinting, the top 10 concentrations that you're looking at. So ESG as a financial factor is demonstrating that integration of ESG actually doesn't sacrifice the returns. It indeed actually enhancing your return values, because you're avoiding companies that have got a high risk in terms of compliances and regulatory restrictions to the governance factors. So this number is pretty interesting, and this has been happening in the Indian markets too. So the investor utility is becoming very, very important for the ESG factors when taken into consideration. One of the other interesting things is about the greening effect. It's about how ESG leadership is lowering your cost of borrowing or capital cost, because greening is a term that is used to describe the yield discount that the issuer with strong ESG credentials that can command in the debt markets. And it has been observed that in both green bonds and general corporate bonds for high ESG rated firms. So why does it happen actually? There's a higher investor demand because ESG focused funds, they have grown by, I would say, more than $2.5 trillion in a year, increasing your competition for high rated ESG papers, to your risk assessment, where the credit markets are pricing at a lower default risk for companies with strong governance, your climate resilience and stakeholder management, to liquidity premium, which is talking about your ESG linked bonds, which is often seen as a tighter bid ask, which is adding to your pricing advantages. What about the quantitative impact? Because OECD analysis says that on an average greening of 30 to 40 basis points, depending upon the sector and the geography you're looking at. The ECB research is showing that about 3 BPS in sovereign green bonds, so up to 25 BPS in corporate green bonds and in corporate issuance that has happened. So the strategic implications for the issuers is in terms of capital efficiency and the signal of the quality, because high ESG scores you're leveraging in the investor relationship to access broader investor base, to alignment on the regulations. So integration into the multi-hazard and ESG for the risk framework has become very, very important, because firms that manage climate hazards such as drought and floods and the cyclones across the board, there's a huge improvement in the ESG scores, therefore leading to higher access to the capital markets. So the higher the scores, the stronger the market perception of resilience and cheaper debt financing we're looking at. That's an important factor, because greenwashing is becoming another important factor. What is it about? It's about occurring when the companies that are exaggerating or misrepresenting or even falsifying their ESG data or information performance with respect to so as to attract lower cost of borrowing and the capital terms. And this can happen via either A, misleading your disclosures, or B, selecting your, giving out selective reportings, or even C, giving out explicitly vague information / data. Because if you look at the entire greenwashing branding that is happening out here, the entire flow, the regulatory context becomes very important, because the investors, they are paying for greenum. This is being perceived by the ESG leaders. If matrices are false, then the assets are becoming overvalued, resulting in the repricing, and that is going to cause sudden bond yield spikes, equity of sell-offs, even the credit rating downgrade. So the regulatory context, such as EU's SFDR or US SEC climate disclosures and ISSB standard, are tightening definitions to the combating greenwashing. So here the use of artificial intelligence and natural and language processing becomes very important, because they're able to use it for the auditing purposes and the ESG statements against the verifiable and unverifiable data. What about the satellite and IoT verifications, that the information that is being frozen from the environmental claims, such as forest covers, your emissions, to the independent ESG ratings and audits, So I'll give a couple of examples. In 2022, major asset fund manager was fined for overstating your sustainable investment criteria. And in 2023, an automated firm, without naming the firm, faced regulatory actions for falsifying the emissions. I am sure the audience would have got which firm am I talking about, without taking the names as much as I wish to. So that is an important factor, because greenwashing will become the biggest challenge in coming days across the board and across the industries. So this greenwashing also brings me to another important factor, is about the use of data and the trust on the data and the AI and the blockchains of the world, and how they're going to be integrated towards for the climate modeling and driving your ESG transparency. Because you automate your ESG scorings by actually analyzing your structured data, your unstructured data, whether it comes from news, from NG reports, from the World Bank, so the world across, and the other banking factors, the banking sectors. What about the compliance and regulatory factors? You're able to detect your inconsistencies between the reported and the observed matrices across the board, whether in terms of satellite data, carbon dioxide emissions, and the corporate claims that have been made, to generating predictive models. So the blockchain also becomes an important factor if you observe out here. It's about recording your data on the immutable distributed ledgers, to payouts, to smart contracts, to enabling your investors. Then there comes in the important factor of your climate models, where you're downscaling your hazard projections from the feeding into the company, and the portfolio risk assessments. So the impact on the synergy is more in terms of your accuracy based on trust and precisions, and the foresightedness based on the AI with climate models, AI with blockchains, and the blockchain and the climate models combined together, playing a traceable scenario financial based decision making, because the better data integration reduces perceived risks, and the tightening of the credit spreads. This is enabling your greenum, resulting in reduction of borrowing costs and high credibility of ESG insurers, and mitigating your greenwashing. So this is how any alignment of ESG takes place, along with the factors that there is an interplay of all the technologies, with the climate models to blockchains to trusted matrices, corporate disclosures, and all these factors brings us another important point. And in bonds issuance, because this is about 60% of your material ESG your company discloses as per the risk that is there. So, the ESG data attributes to your collected data, to your data quality, and how it can be used, all the factors combined together, because they're becoming, how do you do a digital bond which will be forming the token offering which is being issued, so that an STO or security token offering using security tokens, where you're issuing it by electronic means, such as the stocks and the bonds and the other securities. This is resulting projects on the environment and society, and it is representing which is being considered very beneficial for the green and higher ESG bond market. Administered through consortium type blockchain network. Operational process will be complete electronically from issuance to administration term to all the way down to the redemptions. So using technologies will enable the management of the bond registry, as well as the allowing issue on the ongoing basis, which might be difficult in case of Let's look at one of the examples on the ESG analytics on the similar lines. If you look at the social government, you can clearly see that how much is the energy purchase to the reduction over time period from all the way from July 2022 to December 5 emission sources. So we're looking at this area of Europe. So if you upload the data, this is going to get changed as well. How much was the purchased diesel, and you can also see when you hover around, how much is the carbon dioxide emissions. So another platform to play around with, built across the board. That brings me to another important point, and that is about how will you map your ESG, where it has happened, how is this asset that is under stress, where is about understanding the unstructured data altogether, because the AI is not just the changes that are happening in the climate and the natural disasters that might occur because of the change in the climate, bond markets, the capital markets across the world. So it's about unstructured data analysis, where it and the monthly or perhaps even the annual data, which is going to take some time. While this is crowdsource your data, you can have a third-party data, and all of them combined together in the real-time world. So if you look at this map out here from the Morningstar, comparing the scores and giving a complete overview. So let's look at another platform in this case of water pollution as a hotspot. When you look at China, around, it gives me a perspective of how much water stress is and water performance indices have been measured, how will you across the board. So it's another platform to play around with. So another one is on the global map, and that brings me to another one is on the aqueduct water risk at the global. So you see there is a baseline in terms of your to drought severity to the media coverage. So no data versus complete extreme low data. So say take the case of say let's say the case data and give you the entire perspective around this. What zones are under stress in Argentina? You can clearly see which zones are in the Argentina area where the flooding will be occurring versus you can clearly see out here, this is a low areas as far as the media coverage of that. Then you look at the drought severity impact across the board. So now understanding how the impact of GIS, AI, climate themselves. And another interesting thing that has come around is in terms of the geo ESG, where meet your location is meeting your valuations perspective, and that is two companies very different climate risk because it's all about where the assets have been placed and what is that stress, how much is that. Again, coming from the Morningstar indexes, so take the case of domestic issues comparison with the last year. What is happening? How much is it changing? Mexico versus US, and what is at stake and how much is at stake? Now that also takes me similar lines. It's about how is the drought being impacted. So you can clearly see this has been taken case of the US itself to play around with and see what is happening around. So this is a one. And if you look at another one is on the heat alert, how your livestock's happening. So you see that livestock in stress. So we can also look at the forecasting aspects, your zip areas on the yellow side, on the green side, on the red side. So that gives a spatial technology for the ESG perspective. So the geo ESG scores with the location-based hazard exposures so as to create your spatially adjusted environmental and climate risks from abstract to precisely quantifiable. They have standard ESG ratings, they are underpriced or they are overpriced. Averages are not taken into consideration. So your geo ESG factors, whether it is in the coastal plains or which is high, because of the rising sea levels or the approach that one needs to take is geocode asset locations that are there, the factories, the offices. Then the second step is about overlaying the multiple hazard maps to your drought severity, your AQIs, cyclone tracks, heat indices, understanding the quantifying the exposure scores per asset, and the final would be the risk exposures and then investor mandate, because geo ESG indices risk investable, tradable, and measurable, where you're transforming your map. That is a very important factor in terms of the geospatial technologies and combined with the AI in today's world. So, having looked at the ESG from the geolocation perspective and where the valuation is meeting your location-based approach, now let us look at another important thing, and that is, a very interesting point is how can your portfolio heat maps or your The fact that, how can you look at the climate risk when and the returns it is hitting with respect to the geolocations. Because you see, 58% of global equity exposure is in the regions that is facing high or severe physical climate risk. Now, this is as per MSCI Climate VAT 2022 report. Now, because the investors are losing billions, not because the risk don't exist, but because they can't exactly see where is it happening, what time is it happening, and what is happening. So why does it actually matter? Why do these hit risks matter? Because you see, the traditional risk models, they are primarily backward looking. While the climate hazard heat maps is integrating your forward-looking data on floods or say wildfires or even droughts, and also a lot of cases heat waves. So we are able to figure out based on the heat maps what is happening, what kind of a climate hazard is happening, and therefore it is transforming your ESG into a quantifiable portfolio risk that is there. And then the layering of the climate data into portfolios becomes a very important factor. So here is a very classic case of use of artificial intelligence and GIS into ESG for sustainability of wealth and the responsibility of the social factors that needs to be taken care of when investing, So when you're layering your climate data into the portfolios, you start with the portfolio holdings, by geography and the sector, and then you're overlaying it with your hazard maps such as NOAA flood zones, or where is the Copernicus flyer risk, IPCC models that are there, and then you get the visualized cover risk scoreboard that is there by asset and by geography. That's very important. Both the asset and the geography had been intermerged among themselves, and therefore an actionable insight is being generated for the wealth manager's perspective, because you see, you're now able to identify your vulnerable areas, say your REITs in flood-prone areas, or agri investments in drought zones. Then you're also able to adjust your locations to climate resilient sectors and regions. You're able to demonstrate your ESG aligned stewardship to the clients. That also becomes an important factor of the regulatory and the fiduciary pressures, because your EU SFDR and TCFD, they require disclosures of the physical climate risk exposure. So they're explicitly stating where is that risk. Spell it out to me very clearly. And the investors are increasingly also demanding the proof of resilience in the ESG portfolios. So therefore, wealth and SRI differentiator is becoming very important when you're using a GIS-based approach, where you're able to offer climate heat maps positions to a wealth manager who can look ahead of the curve and build a trust with the next-gen investors who are demanding more transparency in terms of ESG impact. Now, one of the platforms in this regard is this, this is there. And if you observe, you can play around with these areas. And let's take the case of USA. What is my scenario model? So average case scenarios, worst case scenarios based on the, primary, what is my property status, risk ratings, region. So if I start playing around with this, and you see, you can clearly see what is the amount of loan to outstanding balance to number of loans, because this is coming from various factors such as motels and hotels, industrial warehouses, office spaces that are existing across. What is the valuation, risk ratings, and all that factors. So if we observe, say, if I am from high risk to moderate risk to low risk, so if I'm taking only the case of, say, moderate risk, which is pretty good, and across, say, two regions, the east and the west all over again. And therefore, we can clearly see how these changes, the heat maps will begin to change. You can put in the appropriate filters, you can see what is happening. And this is a very good approach towards climate change and the change in the portfolio loan risk with respect to the climate change, where you're able to identify the various perils and the properties that are there in the loan portfolio. So this is an example, a very classic example of the use of ESG with analytics and AI for your portfolio heat maps and visualizing the areas where this climate risk is actually existing. That brings me to the end of today's lecture, and thank you. My name is Atul Tripathi, and I'm an honorary adjunct fellow at National Maritime Foundation.